Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program. Hey mate, how you going?
Good, man. How are you? Are you dry? I'm dry.
I am dry. I am dry down here. I'm on the beach today. I'm down in Sorrento, which is, for those of you not from Victoria, that's like at the very south tip of the big bay around Melbourne. So I'm down by the bay enjoying the sunset. And you're not flooded, or you are flooded where you are?
Well, my area was flooded, but we are now not flooded. It's amazing. You know, what is amazing is, it's not amazing that people have actually been flooded and had to evacuate and have lost property and things like that. What is amazing is the fury of nature. Water comes in, it's there for for 2-3 days. This just near my house, it looked like a lake. People were jet skiing on it. and I salute the spirit of Australians who in this bloody bad weather are willing to take the jet ski and their boat and actually find we can't do anything, we'll just boat around. That I think is awesome. But now it's dry. There's a road there and there's like paddocks. And I took photographs of, there were a couple of cows that were stuck on the high end. And I was just thinking, well, if the water keeps coming, they're going to be under. They'll have to swim their way to the other side.
I often see that, right? That the livestock in paddocks, they end up stranded on the little bit of grass that's above the water level. Yeah, it's been pretty scary, all of the water that's been going through southeast Queensland and New South. I think I saw on the ABC last night, Brisbane received 200 mils a day for 3 days in a row, which is an enormous amount of rain. Think about that water. That's
just,
if that happened in Victoria in 1 year, no one would live here. We wouldn't know how to handle it. So I mean, thoughts go out to everyone that's been affected by this, because there've been so many families, businesses that have been affected. I know you can at various places like Officeworks, for example, right now you can donate as you go through the checkout. You can round up if you want to. So thoughts go out to everyone, and make sure you do your bit. Mate, today we're going to talk about 6 companies that are at or near 52-week lows. We've got some US companies, we've got some Aussie companies in here, we've got some small caps, we've got some companies that were mega caps, or not mega caps, but large caps, and now drifting back into the mid cap range, whether that's ASX or global. So why don't we start off with one which is very, very popular, and the thing that we're recording over right now, which is Zoom. Zoom, free cash flow positive, but almost down to where it was, if not down to where it was pre-COVID. So I don't know if you have any updated thoughts on this. I remember us talking about it during COVID. We brought up some results and when they nearly made an acquisition and so on and so forth. I feel like there's some bargains to be had. Is Zoom one of these companies?
Well, Zoom is free cash flow positive, right? It prints billions of dollars of free cash flow, which is really good. I think they're buying back shares. They have announced, I think, $1 billion of free share buyback. So that's good. I think what's weighing on the results is like the stock had run because of COVID in many ways, right? Because COVID basically gave them the tailwind that they probably never dreamt of, right? And it just came, and there were accounts and growth, and so they were what, like close to a $4.1 billion run rate revenue when they finished the year. But if you look at the guidance, right, the guidance basically just calls for maybe 10% growth. Maybe,
yeah, it is.
Right.
Yeah.
So when you look at that tells you something, right? That tells you that it is not that the growth that they saw. So they had 55% or 60% growth last year, right? Or just the fiscal year that just ended. It just tells you that 55% growth that they had, in fact, did pull in or pull forward some of the demand, right? So you can't take that 55% and extrapolate, because the company is saying, well, our growth next year is 10%, right? And we don't know what the following year is. So, so this is an interesting thing. I mean, how much more do we need Zoom? How much, how many of those meetings that were happening on Zoom are now going to happen on in face-to-face? Those are good questions. Yeah. So my main issue always with Zoom has been it's not. So I think the quality of the results are really good, right? So, I mean, that's billions of dollars of free cash flow, several $billions of revenue, growing. Let's say even if it grows at 10-15%, that's pretty good. My issue with Zoom really has been that it is like one product that a lot of other companies have, right? So Cisco has something, Microsoft has something, and in fact, Microsoft has an edge because Microsoft has Teams, which then gets bundled with their Slack chatting bot. Then they can sell it alongside Office. So there's a lot of competition. There's FaceTime. There's there's tons of other things that exist. So I think it's very competitive, and so I don't know what its moat is, and it's very hard to then think how it's going to do over the long term. So I don't have a very good thoughts on the valuation, but there are some reasons as to why it has pulled back this hard, because I think investors are realizing that maybe it is not a 30-40% growth rate into the future.
Yeah, you can see it here on the screen in front of us. We've got the ticker terminal up. 11% growth is what analysts expect, then 14, 11, 12, 16%. This is the top line growth.
Yeah.
The thing that always catches me out is how profitable Zoom is, because it's not like the other tech companies. It's so profitable. But it's like you said, if you're going sequentially from 55% to 11%, people then think, well, okay, you've pulled forward a lot, but how much of that is sticky? And that, I guess the question therefore is, how much do they keep? How many of those customers do they keep? Like I said, we're using Zoom right now. Last time we were on air, I said to you that, oh, well, we use Slack for everything. We use Google Meet because it's natively integrated when we set up a calendar invite for us or for anyone else outside of our business. But then someone on Twitter pinged me and said, hey, you can just get that integration with Zoom. And then instead of a Google Calendar invite, Google Meet invite, it sends the Zoom invite, which has made my life a lot easier. So thanks for whoever said that. But I don't think that we'll give it up, because it's still useful for our business. It's still useful for recordings. And I believe it's still cheaper than the Google Workspace version. So, and that's not to say it's infallible. If FaceTime does deliver with the business style FaceTime, where you don't have to be an Apple user to use it, I think we'll make that transition. I don't know. I don't know if you have a view on how sticky Zoom is, but I think that's the key question for me.
Yeah. I mean, if FaceTime already has the ability to call outside of the Apple ecosystem, right? So you can just send, so you can already send a link to anyone, and they can pick it up on a browser. But what they don't have is the ability to record yet, or transcribe yet. Like, I mean, if they start providing those features, that would be very, very difficult for a company like Zoom then to fend off, right? Because there you go, natively, company with several billion devices has just seeded all these devices with this free software that just works, right? So I think that's the thing. I mean, if it's again, the other way to think about Zoom would be, look, it's growing. Its current growth rate at the top line looks like it's like Apple.
Yeah.
Right. So you shouldn't expect it to have a multiple greater than Apple. And probably I would argue that you probably have a multiple smaller than Apple, because it's not as moaty as Apple, right? It's not Apple. It's basically got one thing. Apple is like a company within a company, right? It's got tons of things that it is doing, right? So, it should be pretty reasonable. If Apple is 30 times free cash flow, why shouldn't Zoom be, anywhere more than 20 times, 25 times free cash flow, as an example, right? I mean, this is just ballparking it. So, so then maybe if it's 25 times free cash flow, maybe it can go down more. Right?
Yeah, well, it's currently 20 times free cash flow right now. So maybe, maybe it's reasonable.
So maybe it is, maybe it's reasonable, right? So those are my thoughts on Zoom.
Yeah. Okay, interesting. I think in the right hands, if it fell far enough, it's probably not there yet, but in the right hands, some other business might look at Zoom and say, you know what, we could bring that into our ecosystem. Something like, maybe not so much like a Salesforce, but maybe something like the Salesforce. I don't know. Maybe there's a business like that. They could say, okay, we'll take that feature and pop it inside our ecosystem and presto, we're even more powerful together. So yeah.
Acquisition floor. Yeah, there's probably an acquisition floor on the share price. I don't know what that is, but I'd say that I think that's right.
Yeah.
And Salesforce could be the one, right? Because they acquired Slack. So it almost seems, one of the things I never understood is why Slack was like, I mean, Slack still has a video feature, which is not very, very good. And almost seemed like Slack and Zoom should like talk to each other. And those are the two companies that I thought should have actually merged.
Yeah. Wasn't that like, sorry, I'm speaking out of turn because I don't know the exact number, but I feel like it was $38 billion what they paid. I'm just going to look at this now.
Yeah, I don't remember exactly. So it sounds about right.
Oh no, $27 billion. Yeah. So, and under Salesforce, it actually has done very well. It's one of those kind of unicorns that are $1 billion of revenue. And so, Mark Benioff has done a great job of making that acquisition when he did. But maybe Salesforce is the business like on that for that acquisition floor. So really interesting. Another company that's we've spoken about quite a bit on the show is OKTA. OKTA is the ticker code. OKTA, really, really impressive business in cybersecurity, does workforce management, customer identity. You can log in with single sign-on through OKTA and you can get into all of your apps in one place very securely. Shares are up 6.7% overnight. We're recording on March 10th, by the way. But the business still has been sold down. So I was surprised to see this. I checked it just before. Shares were up around about $285, now down to around 170. That's, a year later. So the business has been pretty heavily sold down, but fundamentally, it seems to be growing strong. Just in terms of revenue that was recorded recently, $1.3 billion of revenue, up 56%. I'm going for full year 2022 results. An operating loss of $767 million, which was pretty meaty, to be honest. That's 59% of revenue. That was because the CEO basically came out and said, Tom McKinnon said, we made a decision to grow, he said. So, I mean, that's pretty obvious what they were doing. They were spending, I calculated, the equivalent of $221,000 per newly acquired customer on sales and marketing. So I was trying to back that out. I was thinking, okay, well, how many customers do they have that would, bring in ACV above that, annualized contract value, by the way? OKTA has around 3,100 customers who spend $100,000 or more. But as we know, this is really sticky software. It's like a platform. It's like a gateway to the internet, securely into apps. So I don't know if you have any views on OKTA, but it seems like it's steady as she goes. They are ramping spending, which is kind of putting investors off. But I feel like it's just a really sticky wide moat business.
Yeah, so I really like OKTA. A couple of things I'll observe. Which you already said one. So if you looked at the fourth quarter, for example, the operating expenses went up 81%. Right. Part of that was, I think, because they got in Xero, right? So they acquired Xero, that added to the costs. Right. But at the same time, if you include Xero, the revenue was up like 63%, and then your expenses are up like 81%. So you're really, really burning money. The other thing that I think happened with OKTA is just, if you look at like past 8 quarters, there was a time when OKTA was generating. So this was like, if you look at financial or fiscal year 20, OKTA was actually free cash flow positive. It almost hit like 16, 17, 18. And then in fiscal year 21, in Q4, I believe it hit, or Q3, it almost hit 20% free cash flow. Okay. So, and then Xero happened, and then their expenses started ballooning, and then it's been like, on the way down, right? So part of that is just the market saying that, like, you're not generating, you're burning money, and you're spending like crazy, and your organic growth rates are not that high. Like you're spending that much money, but your organic growth is like 35 to 40%, closer to 40%. So I think that's the issue there. But yeah, but I think, as you said, you hit it right. I guess you hit the nail there by saying that, this is a sticky software, right? So basically at scale, this is going to be very cash generative. And they could decide to just, ramp down spending and be highly cash generative. So yeah, I think this is a relatively cheap share price right now, in my opinion. OKTA. I do own shares of OKTA. Yeah, so I
Likewise.
think so I think this is and of course the non-GAAP operating profit being an operating loss is also and it's actually doubling, I think, this year. So I think we're in peak spending, and the market is saying the market doesn't like anything that says we're going to spend a lot.
Yeah, I think the Auth0 acquisition, I think some people would criticize it as being quite expensive, but for anyone that has been around developers before, you'll know that it's kind of the industry standard and it's very, very powerful software. And so I think Okta was the right buyer for that. Maybe you could say Microsoft or someone else that wanted to just dig their heels in even further. But by joining with Okta, it's like it's kind of the perfect marriage between customer identity and workforce identity. So I think Okta is one of those really impressive businesses that in the cybersecurity space. We've talked about Zscaler, we've talked about CrowdStrike, we've talked about a bunch of businesses that you could maybe play on this thematic. But
and Todd McKinnon, nice, beautifully timed the market when it comes to buying Auth0. So they bought it for shares, and I think they paid very close to the peak share price.
Yeah, I think I saw your tweet on that where you said that if they had waited, they would have diluted Okta shareholders considerably. So I agree. Yeah. Another company that maybe we'll jump to the ASX now. I've done two from the US. A company that came out recently was Tyro Payments. So Tyro obviously does the terminals where you can tap your card or tap your phone at connects with point of sale systems, like all of the major point of sale systems here in Australia. The company came out with a result and it basically went backwards from an operating loss perspective. The company made no attempt basically to say, oh yes, we're going to be in profitability at this time. And I think right now, that is not what the market wants to hear. If your operating loss is widening, at the same time, the investors are very, very concerned about capital raisings and these types of things, because as interest rates go up, the theory tells us that capital raisings become more difficult or the price will discount. So Tyro came out and its results, while its results were consistent, they're around about consistent with what the market had expected. If you backed out the TPV or total processing volume, that was kind of just below what it seems like the market was expecting. And then if you dug into the results, you would see that their take rate, which is basically what they keep from every time you tap your card, if you back that out, you would actually see that they did not pass on the increase from Visa and MasterCard when they pushed their extra costs through. Tyro provided rental relief for customers while also absorbing more of that extra cost from the interchange. And all in all, investors just did not like that. And even we have a recommendation on Tyro, and we've seen the share price fall considerably. And I own shares in Tyro. And all of a sudden, the rhetoric changed from, oh, this is the, snatching share from the big banks. It's a leading terminals business, to all of a sudden, whoa, what's the terminal value of this business? What is the value of Tyro after 5 years? Because if they can't pass on the cost to their merchants, I mean, sure, it's great when you can say, oh, we're helping out our customers, but you still have 10 or 11% churn. Does that mean that your pricing power isn't there? Meaning that if you increase prices or you pass the cost on, how many customers do you lose? Personally, I think it was the wise decision not to pass on the cost when, frankly, no one was probably using the terminals during COVID anyway. So you wanted to keep those customers. But at the same time, Visa and MasterCard passed on costs and Tyro had to absorb it, basically. So really interesting business. It's come down a long way. Maybe I'll bring up the charts here. I don't know if you follow it that closely, mate, but Tyro is on the ASX, TYR is the ticker code. Let's have a look here. Yeah. Do you follow it that closely?
No, I don't follow that closely at all. It's interesting, but I think these sort of businesses, they can be actually pretty sticky, right? But I don't follow it that closely at all. So I don't really have much thoughts on Tyro. Yeah,
the business at the top line at revenue, I think you can see here that analysts were expecting or still are expecting about $320 million revenue. We suspect it might come in a little bit below that, but it's really like the operating loss here that's really concerning for people. Even analysts here are still saying that it's coming back to break even in 2024. With interest rates rising, that can scare a lot of people. So with Square pushing further up, Square terminals in Australia, and they're pushing further up the I guess the from small businesses to medium-sized businesses, and that's kind of encroaching on Tyro's space, as well as all the usual suspects like the banks and what have you. So yeah, that's Tyro Payments. We moved it to a hold just because we're a bit uncertain about those operating expenses, and it's okay to keep spending if you're going to keep acquiring, but the terminal value is the big question mark for us. I've had some good conversations on Twitter about this. So if you do have views on Tyro, please reach out to us on Twitter. I'd love to hear your thoughts. So we've got a few other companies to get through. That was Tyro. Another company on the ASX, mate, which is a company that you know better than I do, which is a company called Damstra, trades on the ASX ticker code DTC. I thought this was like Right Crowd, RCW, which is a company I know reasonably well, but Damstra.
Yeah, so I don't know. I actually don't know Right Crowd, so I can't really say whether or not they're the similar things. But this is basically like you can call it workplace management solutions. So like think about a company that think about a mining company. They have people. They go into the mines. You need to comply with health and safety regulations. How do you track where they are, whether they're safe or not, and things like that, right? So that's an example of things that they can provide. And they provide this like some hardware and some cloud-based solutions and things like that. And of course, you just store this data over the long term. That can be used for analysis, and it can be used to comply with various regulations and things like that. So it's a neat little business. A couple of things happened. They acquired a company called Volt a while back, and I'm not. They acquired, and then they had the founder of Volt came in, and then after a while, the founder of Volt basically left. So that happened, and then they lost a major client in Newmont. So that has hurt them a lot, and basically growth has pretty much stalled. Company has had to do cap raises and things like that, I guess. So I think the issue really with this company is they have footprint in North America and parts of Asia where they want to grow. So they're losing money there while trying to grow, and losing North American clients. So if you're burning, say, $3-4 million on those segments, your profitable Australian business is basically having to pick up the bill for that, right? And that can be an expensive thing to do if you can't scale up and scale quickly. So that's been, it's been a terrible stock, I guess, to own. It's basically gone down, and they've had to raise, this was like a $2 plus stock at one point, but they've raised capital at like 30 cents not too long ago, and now the shares are like 20 cents. So so it's been and the other thing I'll say is that if you're like a sub $50 million business, and you're growing at like 10% or 5%, and you're really struggling, then it would suggest that maybe maybe you're not tackling the market, or the market is not there, or the market is not ready for your solution. Something is, there's a product market fit, or go to market, something is not right. So that's really what's happening there. So it's been a treacherous time for shareholders.
Yeah, it has, down from $2.20 in October 2020 down to 20 cents today. That's a big fall. Never good to see if you own the shares, but I guess at the same time, many of these smaller cap companies have been really punished if they haven't been able to turn to profitability as quickly as its shareholders and the market demands when inflation and interest rates are on the horizon. So I think, speaking from my experience with Right Crowd, it's been a similar experience with them. Not reaching profitability has hurt them, even though they are increasing the subscription revenue and their recurring revenue. It has hurt them, not nearly to the extent of Damstra, but this is pretty common across the market. At a $50 million market cap, This is one of those. Does this fall into one of those? Not to put it too lightly, but is this to fall into that category of if you have it in your portfolio? Is it such a small position now that you don't sell it because it's so small?
Yeah, typically that's, so let's say this was, um it was probably a $200-300 million company, maybe even like a $500 million company at one point in time, right?
Yeah.
Even at that point, it's relatively still small. You probably had a small position anyways to start off with, right? And it's now fallen so much that it's like, I mean, it could be taken private for all you know at some price, and still founder run, right? It's run by the founders, so it could be taken private and your shareholding probably has become so small that, if you probably sell it, you're probably going to incur a lot of the transaction cost is going to be pretty hefty. So it's, it's like probably not worth consider selling or anything. Again, I think it's it's just one of those that, you probably just leave it, and maybe it turns around, maybe it doesn't. If it doesn't, it's a memory, it serves as a lesson. If it turns around, then it turns around, in which case so it's fallen a lot. So, when something falls like by a factor of 10 from a peak, if you bought it at the peak, then it's a tiny position.
So the next company that we're going to shift gears back to the US is a big company, at least by Damstra standards, which is Shopify. Basically, every company in the world that is involved in any type of e-commerce or any type of, managing customers' data and serving customers online or even in person nowadays, it seems, says we're going to be the Shopify of insert their industry. This company has set the standard for e-commerce, for managing online stores, etc. We've talked about it quite a few times. The company has basically also set the standard for how quickly you can lose $1,000 in a share price. It's gone from $1,668 a share on November 15th, 2021 to $587 today. This is March 9th, 2022. So it's basically wiped 60% off its market cap in a few months. But still embedded in so many customers' workflows, websites around the world. We know there are competitors in the space. Adobe has one of those competitors. Some of the other businesses have competitors for e-commerce. WooCommerce is there. There's so many different competitors, but Shopify is the standard. I'm not sure what to make of this. It jumped 14% overnight. Really interesting business, wide moat business. They're turning to free cash flow profitability. So I'm interested to hear your thoughts, mate.
Yeah, with Shopify, large. So I'll say that yes, last night was weird because a lot of stocks were up like 5-10% on pretty much no news, I would say. But so the results for the company were actually pretty good, right? I'd say pretty good because the last quarter's revenue was something like $1.4 billion. And it was still 40%, 41% or odd growth. Now the growth was a slowdown, so there's deceleration in the growth. And I don't think Shopify actually explicitly provides revenue guidance as a company. So, they're very fuzzy about guidance all the time. I guess the one thing to take away was subscription revenue was down. It only grew like 26% year over year. Right, it was the merchant solutions that grew 47%. Right, so basically, you can say that the deceleration was largely a byproduct of, I guess, slowdown on the subscription side. Right, so. And then if you think about the type of clients, so Shopify does serve large clients, enterprise grade clients as well, but its bread and butter really is the SMB, right? And I think one of the things to realize, and it's really geared towards like the online first, right? It's really geared towards the online, like people who said, okay, I want to sell jewelry and I want to do it quickly. How do I do it? I do it via Shopify, right? You don't even open a store. And there was a lot more activity around that through the COVID crisis, right? That's number one. A lot of people buying things online, and people would, buy stuff online because they had nothing else to do. Like, you have, you're earning, if you're working, you have nothing else to do. You want to buy some fancy jewelry online, you just do it, right? Now you probably go to the mall and, and look at stuff and then decide what you want to buy. So there's that element at play. The other element at play is the overall slowdown there would mean that there will be a lot of churn happening, right? And that's always the case in Shopify. There's, so any company that serves the SMB sector sees a lot of churn.
For sure.
Right. So, but I would say that the churn might be elevated because there might be some businesses that are going to go away. That, they were only COVID only, that had a business during COVID. And the interesting thing with any small business is that there's a fixed cost to run the business, right? And you're operating it above that fixed cost, then you're making a profit. But once you start dipping below that, you don't have a business anymore because you're making losses, and you can only sustain losses for so long. So I think that's the other dynamic at play. A lot of e-commerce companies have reported slowdown, especially those around, serving SMBs and things like that. So that's played into the share price. The final thing I think, and this is maybe an odd thing, is a lot of small businesses get advertising done through Facebook, whose advertising has been impacted because of iOS. So there's that element too. This is, in many ways, there's a confluence of factors that have sort of, COVID happened, which gave an acceleration. Then COVID sort of, went away in the background. There's a deceleration. That deceleration is coupled with, changes in privacy from iOS's point of view, which then has impact on Facebook and other advertising platforms, which then, so there's a confluence of factors that is pushed. But I still think this is a great business, right? And Toby is a fantastic leader. And, he's really building the Amazon for the masses, right? This is really his thing, right? He's building the Amazon for the masses, for the little guys, the Amazon for the little guys. So I think, I think the share price looks attractive, actually, to me. I do own some shares, and it's not a big position for me. I actually I didn't buy into this thinking I missed the boat. Then eventually I bought it on a pullback, and then on that pullback has further pulled back. So maybe now is the time to actually think about adding to the position. But yeah,
when you think about,
yeah,
sorry, go on.
I like this business. Sorry, yeah.
When you think about the size of the TAM for this business, the market cap fallen from $180 billion in 2021, FY 2021, down to $75 billion currently, still growing, still reaching inflection points. It's super impressive business. And this is yet another one of those businesses which probably has so much latent pricing power inside it that it's not even realized yet. So yeah, really interesting business. I think this has got to be near the top of my watch list for US companies. Surely this is a business that, yeah, industry leader. I think it's one that demands further research. If you do have any more views on this, we'd love to hear from you on Twitter at 7A Mahanti and at Owen Rask. So the final company is Xero, which is the Kiwi/Australian, we'll claim it, cloud accounting software business, rivals Intuit outside the United States. Basically, in the United States, it's pretty far second place for them. But Xero has really released no information since reporting, and yet it is being aggressively sold down. I'll bring the chart up for those people who are watching rather than listening. The business, Xero, as we know, it's super sticky, lots of pricing power, switching costs for consumers. We can see here, which is November 1st, 2021 was trading at $154 a share, now down at 97. So, losing 30% or more of the share price pretty quickly. Subscribers everywhere in the world are growing, even though it dominates in New Zealand and Australia and the UK, it is still growing. The UK still has quite a fair way to run, in my opinion. The United States market, which is fascinating to me, because I know there were a lot of bulls a couple of years ago for Xero to take a big slice of the pie away from Intuit/QuickBooks. That really hasn't happened, but it is still growing at a rate which in the United States, which I thought was really, really impressive. So I can't really, fault the business in any way. I would think maybe what the market is concerned about is obviously, a lot of global uncertainty, a lot of investors worried about what inflation means to small businesses, wage inflation means. There's a lot of compression in small, medium business margins there. So I think I did a very, very short Twitter poll on this, and I basically said, if you use Xero, would you cut it? You know, under what circumstances would you cut it, basically? And everyone said they could charge me $200. I still wouldn't cut it. For your reference, they charge about 55. So I think this is a business that, yes, we will see maybe some turnover in the small and medium enterprise segment. As you've always said, that is kind of part and parcel of that market. If you deal with retailers, if you deal with physical stores, if you deal with basically any small and medium business, you're going to see some of the level of churn. But Xero for me, under $100 is, I think, for a 10-year view, I really like Xero. I think the app store that they've got growing, I think their ability to make complementary acquisitions, whether it's in the United States, the UK, elsewhere, they've got a lot of firepower now. On an EBITDA basis, they're profitable, and they're just going to get more profitable, in my opinion. The marketing, yes, in the United States and the UK is less, less tempting for the business. So we're seeing, a worse relationship between lifetime value and customer acquisition cost. Most companies break that down, lifetime value divided by CAC, and they put it in months. And the relationship there isn't nearly as strong as it was in the ANZ markets early on, but that is okay. I think that the UK's and the American market are tougher markets to crack, and if they can do it, which they seem to be doing, really positive. So I don't know if you have any views on this, but I still really like Xero. I own the shares. Personally, it's one of my biggest positions, and I'm quite happy for that to be the case.
I think, like as you said, like in SaaS business, the only thing I would say is, in a SaaS business, these businesses can continue growing for a long time. And then the rate might be lower, but they'll continue growing. And once you're profitable, you'll get a lot of operating leverage coming through. So you'll be cash generative at that point. I actually always thought this business is going to get acquired.
That's what I thought too. Yeah.
I always thought that this is going to get acquired. I always thought that it's a good acquisition for Intuit if it wants to be like basically the leader in the space. You just get the complementary markets of the UK, Australia, and New Zealand, right? And given how important, it looks like Australia and New Zealand is not an important market, right? But if you think about some of what the global companies do, look at Square, right? I mean, among the outside markets, it's not that big in European markets. I don't think they've just launched into some European markets, but they're here in Australia. Apple would always launch a product here pretty much simultaneously. And if they have to test, when they launched the HomePod, we're like a test market in many ways for them, right? So I always thought that Intuit would ultimately acquire, maybe the price, at this price, at the $150 price, they have to pay a premium, but at a $100 price, they pay like in 20%, 30% premium, and they can acquire it. I think there's an acquisition floor at some, I don't know what that price is, but there is an acquisition floor, I think, for this company.
Well, Xero's $14 billion market cap. Let's have a look. Intuit's 131. So it would probably be a script offer, and they could probably do it. I wonder if there is any competitive issue around that because of both of them being the dominating software in Australia and not so much the US, but maybe the UK, maybe Sage is, you could probably say Sage is competition in the UK, MYOB is competition here in Australia. But I thought when Rod Drury stepped away, he was the founder, that something like that might have happened. But Steve Varmos from Xero has just kind of led the business from strength to strength. They did a convertible notes offering a little while ago, and they never really put that money to use. So it looks like if you look at Xero, you think, oh, it's got a bit of debt. It's actually because they've got the cash still sitting there from that raise. And, that doesn't necessarily seem like a bad offer. In fact, I think if I could own the convertible notes, I probably would. So, I think Xero is a really interesting business. I think there aren't that many really impressive tech companies like this in Australia that are having success overseas. So this is one that I would look to top up on during weakness, like we're seeing now. Neither of us have any predictive ability in the short term, to be sure. We're not saying that these businesses are going to suddenly bounce back and in a year you're going to see double-digit returns or anything like that. But what we're saying is fundamentally, many of these businesses are quite strong. So just to recap, we've talked about Zoom, which is free cash flow positive, maybe has an acquisition for OKTA growing. Now it's got the Auth0 acquisition bedded down. We should see some normalization in that, and hopefully those customer numbers keep growing. Tyro Payments, which is still experiencing a bit of bloat, maybe through a bit of wage inflation and new hires. Damstra down from $2.20 odd to 20 cents after doing capital raising at 32. That hurts. Shopify, also down a long way, shaved $1,000 off its stock price, which is a big deal when you consider it 60% odd. And Xero also down about 30%. One of Australia's and one of the New Zealand's leading technology companies, and still growing fast and sticky. So a really interesting kind of strong, for the most part, a pretty strong bag here. Maybe we could say that Damstra's maybe not in that case, but 6 really interesting businesses. So all worthy of a spot on a watch list. Hey mate, did I hear correctly? I tuned into a Spaces this morning with Simon Erickson. Is it 7 Investing's birthday or something coming up? Or is it like an anniversary, or is there something coming on?
So it's anniversary. I think the March is the anniversary month. So I think 7 Investing started in March 2020. We have a deal for anybody who wants to join. They can use a code called birthday at checkout, and it gives you $100 off the annual subscription. So instead of $3.99, I think it goes for $2.99. Yeah, so if anybody's interested.
Just writing this down now. I'm going to put it in the show notes. Birthday coupon code. What do you say? $100 off the annual.
Yeah, annual sub. So from $3.99, it goes down to $2.99. And you can lock in that price as long as you stay members. It's not like a one-time off. It's off in perpetuity, the $100.
And you get all those ideas flowing thick and fast every month. Why not? Birthday is the coupon code, 7investing.com/subscribe. I do not have any coupon codes, unfortunately, to share for Rask, but if you're going to join 7 Investing, now sounds like the ideal time. You get $100 off. And as always, you can find us on Twitter, full links in the show notes. Be sure to reach out to us if you have an opinion on Zoom, OKTA, Tyro, Damstra, Shopify, or Xero. We are all ears. We love to learn from you. So reach out to us and say hello. I get a few messages when we do these shows, and it's great. Actually, I will call out one thing. I will put a link in the podcast player. If you're interested in my reading list, so a reading list that I give to our analysts, I've got some of my favorite books in there. I've got some of my favorite podcast episodes, not just from Rask, but from around the world. If you want to become a better investor, it's a free download. It comes with a Google Doc form, so you can Google Docs, so you can just download it and put all your notes in there and whatever. It's just a free reading list and podcast list. Check it out. Got some videos from Pat Dorsey and all over the place. So have a look. It's in the podcast player, mate. As always, it's my absolute pleasure. Stay dry, stay warm, and I'll see you next time.
I'll see you next time too.